Welcome to Tradier's The Trader's Edge. I am Jim Uriel. That's Bob Iaccino, dressed in a sunny, almost, what's fluorescent mean? Is that like light, bright, whatever? It's a blue shirt. It's
Wow.
light. It's very sunny. I love it. What
About
happened?
as pastel as I get.
It's pastel. That's the word I was looking for. Pastel. I'm so
Yeah, it's
glad
as
I didn't
pastel
remember
as
the
I
word
get.
pastel.
Yeah.
Okay, before we talk about finance, we're going to bring in our guest. I want to talk to this. The other day, the Canadians booed our national anthem, and then we beat the crap out of them physically and on the ice in the game that followed. Big deal,
Yeah.
little deal. Did it make you patriotic? What did it do?
Honestly, that kind of stuff is fun to me. When you're seeing national team against national team, that stuff doesn't bother me. I mean, when I used to play high school football, we teams would boo each other's crowd, boo each other's cheerleaders. It's sports. It should be that way. I mean, I think overly kind in sports it's boring to me.
But you're not opposed to the Americans then dropping their gloves as soon as the puck drops and beating up three of them, right?
Opposed to it.
Opposed
That's what I would coach if I were the coach.
exactly right.
Yeah.
I said I was on with Tony Greer and Jared Dillian earlier today, and I said, growing up, it was college before I realized that everybody didn't just settle all their disputes with punches to the head. And I'm like, and I like your system better, but back in the day, it was much more simple, I thought.
Canadians, I love them.
Too. Anyway, we have an excellent show. One thing I always say is you may have watched Bob and I on media for the last 20, 25 years. You might think we're full of shit, but you cannot argue the fact that we get great guests, and we have another one today. We have Gordon Johnson, president and founder of GLG Research. Let's bring in Gordon. Gordon, did you like when the hockey players beat up the Canadians? Did you think it was funny or no?
I honestly didn't see it, but I'm definitely pro USA. So if we're winning, I'm all for it.
What sports do you watch?
I'm sorry, what's that?
What sports do you watch generally?
I don't get a chance to watch much, but I caught the dunk contest, and I actually like the new format for the All-Star game. It
I
seemed
love
competitive.
Hold on, what is it?
Well, they have like a tournament. So instead of just one game, it's a tournament. And they put young guys against the young kids against the older veterans, and then they put the international players against the veterans. So you can't just slack off the whole game. I thought it was quite entertaining.
They also, Jimmy, they didn't have a time limit. They had a score limit. So first team to 157 wins.
Wow.
40. It was 40.
147.
Yeah, that's amazing to me. I didn't know they were switching this. I feel bad. Ever since Michael Jordan hung him up, I've just not been that much into the NBA. I feel like I got just so spoiled. But there's some amazing athletes. There's some wild shit to see, I think. And anyway, let's talk about markets. It looks today that Bobby and I think that we could be breaking out of a pattern in the S&P, heading higher. Valuations are stretched. We all know that they're stretched. What level of bull/bear are you right now?
Me.
Yeah, you.
Yeah.
You're the guest. They don't want to hear us talk. They've heard our shit for too long. They want to hear you.
Yeah, so I think that if you look at what so Wrightson predicts what the Treasury is going to do with the TGA. Let me take a step back. So the way that we look at the markets in general is liquidity defines what the markets are going to do. And the way we define liquidity at GLJ Research, our investment strategy team, is not just the Fed's balance sheet, but also the TGA and the overnight RRP. And the overnight RRP is essentially excess liquidity printed during the 2020 to 22, QE infinity timeframe. That was essentially a buffer of money. It's not on the Fed's balance sheet. It was a buffer of money for the Treasury and the Fed to use as not QE. It is QE in times of need. And that number has fallen from $2.4 trillion to I think we're at 70 billion or so today. So that number is running low. And more importantly, if you want to see what's really happening with liquidity, you look at bank reserves held at the Fed. And if you look at bank reserves held at the Fed, despite the fact that the Fed has been doing, quote, QT for some time, since they started QT, bank reserves held at the Fed have virtually not fallen at all. And what that means is all that money they pumped into the market recklessly, I might add, during the QE infinity period, they've done virtually nothing to take out. So inflation is going to continue to rage higher, right? But that also means assets are going to continue to melt higher until they get serious about reducing bank reserves. Now, with that said, what are we looking at? So we have a debt ceiling impasse, right? And that's not going to get resolved until mid-April. So if you look at what Scott Bessent, our new Treasury Secretary, who, by the way, poo-pooed on Janet Yellen, said she's focused too much on short-term debt issuance, and then with his QRA, basically did the exact same thing as far out as the eye could see. He's Yellen 2.0 so far. So there was a bunch of talk. He was selling wolf tickets. He's extremely Yellen-esque. So what is he going to do? So with the debt ceiling impasse, right, the Fed, the Treasury effectively can't issue debt. So what they're planning to do is significantly draw down their roughly $800 billion Treasury General Account balance. So again, Fed balance sheet, overnight RRP, Treasury General Account balance, those three things add up to liquidity. If the TGA is falling, which Scott Bessent is set to do, and over the next 2 months, roughly 8 weeks, this guy's going to drop that number from roughly $830 billion to $230 billion, or just over. So you're talking about $600 billion of QE that this guy's about to do, right? That's going to be a massive amount of liquidity into the market, which all else held equal is extremely bullish. So you have that dynamic, but against that backdrop, right? And the reason why the equity market rebounded today, you have the Fed in their minutes today saying we're considering stopping QT, right? Market got excited. What the market didn't see, which is way more important in my view, is the Fed said, in addition to that, if we stop doing QT, we're also going to stop reinvesting the maturities of our bonds into U.S. Treasuries. So they're going to reduce the weighted average maturity of their essentially bond holdings, which would be very bad for risk assets, i.e. stocks. What that means is the Fed is going to stop buying long-dated U.S. Treasuries at the same time, given the massive spend from our government, that the Treasury needs to issue a lot of new Treasuries, which means yields will go higher, stocks will go lower. So I think the market may have misread what the Fed was saying today. And one of the best guys I talked to on Twitter, who everybody knows, Danny, he's saying that they're just mentioning this in the minutes. But I'll note, when they put something in the minutes, it has to be a unanimous vote, and it's usually something that they plan on doing. So I thought the minutes were actually more hawkish than the market thinks. So all that said, what's going to happen near term? I think the near term is bullish given what Bessent is set to do with the TGA. And until the Fed actually acts, you're going to have liquidity in markets. That's a melt up of risk assets to include stocks.
A quick follow-up to that, because you mentioned we've all seen what happened over the last 2 years when they tried to sell too many duration bonds and the market was sloppy. It didn't really love it. The appetite wasn't there.
Right.
Is it possible that even Trump today said instructing the military to cut 8% of its budget every year for the next 5 years? I don't know if you guys saw that headline. It just came out about an hour ago.
Yeah.
The Doge stuff, if it's real, if it's not real, I don't know. But is there a scenario where we're running bigger deficits? They're running down the Treasury General Account. They're running down RRP, spending a shit ton of money. But the plan is to spend less money, and the market can see that, or the global demand for bonds can see that, and they buy our bonds anyway, even though we're running bigger deficits because they believe there's brighter pastures ahead or something. What do you think?
No. So Trump is going to spend a lot of money. I can't emphasize that enough. So let me give you an example. So, right, you guys have been following this Doge committee.
Heard something about
Elon
it.
Musk,
Yeah.
right? Yesterday, they said that they had saved $55 billion. But then you go look at their own website, and the number is $16 billion, right? And then you find they said one savings was $8 billion, where they put an extra zero, and it was actually $8 million. So really, the number is like something like roughly just under $9 billion, based on their numbers annually they're saving. And one could argue those numbers don't include a lot of costs associated, right? So despite that fact, Elon Musk is talking about giving out $5,000 checks to every U.S. taxpayer, which is the equivalent of spending $800 billion. So based on their numbers, this is Doge's numbers, which I think are questionable to say the least. They're saving $9 billion annually, yet they're talking about handing out $800 billion, right? So that just shows you that the math they're doing is cockamamie
Not
math,
the same math as we do.
They're looking at spending way more than their alleged savings. In addition to that, right, Trump is talking about tax cuts in the trillion, while this Doge committee has saved theoretically $9 billion a year. So the point is, the idea that we're going to cut spending is laughable at this point. And Doge just gave you a bird's eye view into what they're thinking, which is handing out, basically payments to taxpayers when they haven't saved anywhere near, based on their own numbers, what they're talking about saving. So listen, you guys remember what happened in the UK, right? With Liz Truss. Remember over the weekend, she had to resign. The bond vigilantes came to town. And essentially, it's a fancy way of saying bond investors. And what happened was Liz Truss had all these grandiose plans. She was going to do all this spending. And the bond market in the UK said, hold on. No, you're not going to do it. We need a higher yield. And yield skyrocketed. And very quickly, due to market forces, she had to step down. And the guy who replaced her had to pull back all those spending plans. I think a similar event is waiting for us in the U.S.
Yeah.
So I want to do something here, and I want to push back a little bit on a couple of things. The dividend idea, the $5,000, came from a guy named James Fishback, who is from Iuorio Capital. He is a Trump surrogate, I'd say. I don't know if he's officially a Trump surrogate. He also happens to be a friend. I went to dinner with him a couple of days ago, and he happened to be down here in Florida. And what he said to me before he even tweeted it is, he goes, I want to put this out there to Elon and to Trump, that based off the $2 trillion they anticipate spending, giving 20% back to the public in the form of a $5,000 dividend check. So that's $800 billion. So that math works, right? Now, I think that the stupid part is they said, we're going to give you $5,000, because it's not going to be that. Because if you just go by the sort of Murphy's Law of, this isn't quite Murphy's Law, but they're not going to save $2 trillion. I think we all agree on that, right? So throwing that $5,000 number out there, I think is silly. But I don't think they're saying off of what they've done so far, they calculate $5,000 per taxpayer. And please cuss me out, yell at me. I don't care. You're the guest here. I'm not trying to be a dick. So I think that the $5,000 is typical of this particular administration, where they just say stuff. And at the end of the day, we say it all the time here, you take Trump seriously, but not literally, right? That's number one. Number two is, how close do you think they're going to get to savings at all? Not just based on Doge, but based on other proposed cuts that may happen. I hear you saying none of this is going to happen, and the spending is going to far outweigh it.
Right. Okay. So with respect to your buddy in Florida, I mean, they're supposed to be cutting the deficit, right?
Yeah.
So
agreed.
If you take the perceived savings and then hand that back to taxpayers,
well, 20%
not only
of
are
it.
you not cutting the deficit,
20% of it.
You're pouring gasoline on the inflation fire.
That I agree
is
with.
ravaging the U.S. economy. We can get into this. The U.S. economy is nowhere near as strong. I would argue it's quite weak versus expectations. So I think, respectfully, I think it's a very poor idea to just hand money out, right? We've already seen what happens when you hand checks out, right?
Yeah.
The bulk of it goes to the rich. There's significant fraud, and it results in backbreaking inflation that brings the majority of Americans to their knees. We don't need money handed out. What we need is we need costs cut, and we need the Fed to focus on what they were created for, which is keeping prices steady. So I'll highlight that. Was there another question in there?
No, I basically was going to say that next, and I decided to let you call me an idiot, which I would agree if you did. But just from a perspective of, like, I don't think any of it should be sent back. I think if there's any savings at all, it should just go to reduce the debt and the deficit.
Oh, yeah.
Because The one thing I don't think this administration is prepared for, based on everything they've said. Everything they've said is about putting money to work in an economy that I think still has 3% inflation. I've been saying since last year that the inflation dragon has not been slain. And now we've got an administration in here. All they're focused on is let's grow, let's grow, let's grow. With unless we get a productivity miracle, you're not going to beat inflation with this. Egg prices are not going to go down, which was promised. Energy is not enough for me. So where do you think inflation is? Because I think we all disagree as a general rule on where inflation is right now. But where do you think it's going based on what you've seen so far?
I think inflation is headed significantly higher, and it's very simple. You have a Fed that has allowed financial conditions to ease to levels that are below, since financial conditions are easier now than before they started hiking rates, right? And you have bank reserves, again, sitting at levels that they were at before they started QT. So it's very simple. If you want inflation to come down, you need to tighten financial conditions and push bank reserves lower, right? Bank reserves need to fall and financial conditions need to tighten. If the Fed does that, which they could do tomorrow if they wanted, inflation will start to come down. If they don't do that, which they're not doing, inflation will continue to go higher. And the problem is the U.S. economy is nowhere near as strong as the pundits would have you believe. I mean, it's very political, right? When Biden was in office, the reason why listen, this is my opinion. The only reason Trump won was because of inflation. Had nothing to do with anything else. If inflation and thus people's personal economies were strong, Biden would have won. It wasn't. And if Trump doesn't slay the inflation dragon, he'll get crushed at midterms and he'll lose again in 4 years, right? And as of right now, that's not what the focus seems to be. And I think that you need a Fed that's serious. They're not data focused, right? However, today's minutes suggest they may be shifting that way, but we're not there yet. And you need a Treasury that's serious. And based on the QRA that came out from Scott, the Senate, he's not serious. He's continuing along the Janet Yellen path of recklessness. So until that happens, you know, you're going to have, and we can talk about, you know, stock markets, and, you know, what I think is kind of the key things to look at, but you're going to continue to have inflation. And I think that's bad overall for companies because people are basically at their wits' end with respect to further expenditures. You know, think about it, right? The most recent real inflation adjusted data, year over year retail sales comps, they were up just 1% versus December 2023. This is December. Scores of retailers, FedEx, UPS, and FedEx and UPS posted results that reflect tough business environments. Target, Macy's, The Gap, Ross Stores, McDonald's, Sherwin-Williams, Nordstrom, Dollar General, Foot Locker, Lowe's, Home Depot. These guys are all struggling. So the real economy, right, evidenced by what we actually spend money on, is in decline. And it's going to get worse until inflation gets better. And clearly, CPI, right, PPI. Just yesterday, you had what was it? Empire prices paid. All of
New York Empire
surging higher, and yet the Fed is talking about, you know, they're restrictive in clearly their policy is not restrictive. Nominal GDP growth is ahead of inflation. That is not restrictive. And you know, these things are now surging higher. So it's not inflation is going higher again. And keep in mind, think about this. So since March of 2020, if you track CPI inflation, you assume 2% annually, which is the Fed's target, and you look at what it's actually done, right? It's 11.9% above that 2% trend line. So you understand what I'm saying, right? You look at CPI prices, you assume 2% per year. Inflation is done like this. You're almost 12% above, right? They were talking about, so when inflation was low, they said we're going to use average inflation targeting, right? Inflation has run significantly above. And by the way, their target is arbitrary. The Fed wasn't created to increase prices 2% a year. They were created to keep prices steady every year. 2% every year means your dollar decline gets cut in half roughly every 20 years. That is not why they were created. So their target is arbitrary, but even based on their arbitrary, ridiculous target, they're way above. So they use average inflation targeting to get prices up, but they're not saying they're going to get prices down, i.e. negative inflation. They just abandon those goals when it gets out of whack. So
right.
So here's one thing I disagree with you on is that I think you said the Fed's target is 2%. I think that's bullshit. I think the current Fed target is about 2.8, 2.93%. We've been saying that for a year. He can say all he wants. He's told us for decades that he wants inflation to run hot to counterbalance all the years it was below his target. I think he's comfortable with 2.93%. Am I crazy?
You're not crazy. I'm just saying that's their official target.
Yeah. I was
the
just
evidence
kidding
shows
you that I disagree.
We've been above 2% for what, years? So the evidence shows they clearly don't care about 2%.
Clearly
right?
don't care.
When we were below 1 point, when we were below 2, they were willing to do all these things to push it. So yes, the evidence suggests you are indeed correct. Keep in mind, right? Charlie Munger, right? There's a book called The Value, I think it's called The Value of Time. And it goes through history and it shows you the downfall of most great empires was financially driven. Even the rise of Hitler was preceded by the fall of the Weimar Republic and hyperinflation. Charlie Munger said the only thing worse than nuclear war is inflation, right? And they're letting this thing get completely out of hand.
So it sounds to me, let me interject real quick, because it sounds to me, one thing, a drum we've been beating on this show for a year is the commodity drum, because we believe that inflation was going to run hot. And inflation, Bobby always says, gold is not an inflation hedge. Gold is an inflation hedge if the market believes that the Fed is not going to adequately fight inflation, which is the exact situation we're in right now. So is one of your main focuses for where you want to invest right now, the commodity space?
Absolutely. We recently upgraded. We cover the steel stocks. We really recently upgraded the steel sector. We have a buy on U.S. Steel, buy on Cleveland Cliffs. We think Trump's tariffs. Our view was that Trump is going to come in and put tariffs on steel. Clearly, he did that. We know how this works. Like, some conservatives may deny this, but the last time Trump was in office, he put tariffs on steel, right? You know what happens? Not only do prices go up for the imports, right, because the people here have to pay for it, but the people who sell steel here jack up their prices immediately. They immediately, even when he was just talking about it, the steel mills in the U.S. are using that to jack up prices. So we think commodity prices are headed higher, maybe for the wrong reasons, but clearly that's also inflationary. And with respect to gold, it's clear that this Fed has no intention of fighting inflation thus far, right? They've shown that to be true. And the ridiculous questions you get at these pressers from the media show you that nobody's going to hold their feet to the fire. These guys are held up as almost like deities, despite the fact they've been the wrecking ball to the average American, right? I'm talking about, the wealthiest 10% own 87% of stocks based on their own data. Yet they treat stocks like they're the economy. So the point is, like, if they don't get this thing right, there's bad things coming. But over the very near term, given Scott Bessent is about the Treasury Secretary is about to put his foot down on drawing down that TGA, which is effectively QE, barring more bad inflation data or the AI bubble popping. I want to talk about that. Barring those two things, I think that you get melt up in risk assets in general.
So I'm looking at, I just want people to get this while we're in the meat of the show here, GLJ Research. I'm looking at glj-research.com. That's the best place for everybody to get all your research, right?
Absolutely. Yeah, correct.
Okay, so I'm looking at the reports. They cover automotive, cannabis, industrials, metals and mining. What else is under here? It's
EVs, solar.
Yeah, renewable energy, specialty chemicals. So if we could, I want to talk about automotive real quick. Correct. You're known for your stance on Tesla, and Tesla, the stock, has been in a pretty significant downdraft. Basically, since it made a new all-time high about December 18th, it's dropped to 33%, over 33% on its lows. It hasn't recovered all that much. What else do you cover in the automotive space? And do you have a buy on any of it, or is it all just sort of hold, or what are you thinking with the inflation story? Seems to me like you might have an opinion on this.
Yeah, so right now, Tesla is the only automotive stock we cover. But clearly we have, if you cover Tesla, we have tentacles into pretty much every automotive company.
Sure.
Yeah, so in general, we're not positive on autos. given parts inflation that we expect, as well as Trump's tariffs, as well as what we think is a very stretched consumer. But that would be our general take. We can get into specifics on Tesla if you want, or we can focus elsewhere.
Actually, let me ask you a question that just came through in the comments here on the people that are watching live. Tim, who's a friend of the show, said, does Gordon have any thoughts on why uranium prices keep going lower? It seems like nuclear power is in vogue right now. The smile says you have an opinion. I love it.
Yeah, so we covered Chemico. We're uranium bulls. So what's effectively happened is the volume of trades in the spot market have imploded. And as a result, opportunistic buyers are using that decline in volume to push prices in the spot market lower. So if you look at it's very undercovered, but if you look at the contracted versus spot market prices in the uranium space, there's a huge gap. So I would say that the reason why the spot prices have come down is because volumes have collapsed. There's seasonality in spot buying, as well as the fact that people use that. And when I say people, buyers of uranium use the spot market to try to manipulate contract prices. So I think it's a near-term phenomenon. But when I take a step back and I look at the supply-demand dynamic in the uranium space, I couldn't be any more bullish. It is somewhat of a longer-term call, but you just don't have the capacity. In a nutshell, here's what happened. Fukushima happened, right? And then the entire world at the time was extremely liberal, and every single country virtually shut down their uranium capacity. So prices went from 100 to like 20, and people thought, left uranium for dead. Now, all of a sudden, because we're seeing that, intermittent peak load, solar and wind power are not a solution, right? It's not a real solution, right?
Surprise,
when the sun's
surprise.
not shining,
Yeah.
or the wind's not blowing, you don't get power. Now people need distributed baseload power, right? The only real renewable distributed baseload power is nuclear. So now all of a sudden the world's saying, all right, give us nuclear, especially with this AI BS. So the problem, though, is you don't have the capacity. So you have demand significantly above actual capacity. And so you're going to have prices go up. But the problem is it takes a little while to build these reactors. So there's a tug and pull there. But when I say long-term, the supply-demand dynamic is one of the best I've ever seen. And one of the things my firm prides itself on is getting involved in these supply-demand stories. Admittedly, we told our clients to buy Chemico around 16. The stock's at 50. So the question is, do we still like? The answer is absolutely. But the next leg up is going to be as more and more countries realize that solar and wind aren't real solutions. And that's happening.
Gordon, how do you like to express uranium when you guys look at it? You guys look at like a Sprott miners or ETF?
We like the miners. We like the miners. So you're talking Chemico and Kazatomprom.
What about UEC?
No view. No view.
No view. Okay, that's the only one I
have. I would express we would be long, and we'd be long the guys who have the lowest cost miners.
Could we take a quick time out? We got a Louis. Can you run the banner? Are we ready?
I'm sorry?
Because I do know there's a quick time out. I want to talk to the fans for 1 second who are watching, which we so appreciate you guys being here. Can you do us a favor? Try Tradier Pro for 3 months for free. There's absolutely no obligation. We've had options gurus on this show, and when we mention it, they barely even know they're on the Tradier platform because we just call them and say, "Hey, look, can you come on our show?" And they're like, "Oh, that's the platform I use." So it is tested, it is approved, and there's no obligation. So please click on it, give it a try. It's great for any options trader. Thanks. Please go on. Pretend I didn't say that. Pretend we're back in action. Yeah. Yeah.
So what else do you favor in the commodity space? And I do want to get into things like specialty chemicals and some of these other stocks, but what else do you like in the commodity space?
So we like the solar names. We're actually recommending shorting the iron ore names, and that's very simple. The China housing bubble has burst. Clearly, everybody knows that. But 34% of China's steel demand, roughly 30% of China's steel demand is the housing sector. And the problem with China right now is while everybody expects stimulus, they can't stimulate. And the reason is because if they were to stimulate they would need to do trillions of dollars of stimulus given all the bad investment they've made. That would significantly depreciate the currency and also cause more hot money outflows, meaning money would leave China. So it would decimate the masses to the extent that even though it's clearly a communist country, you would have riots and uprising, the likes of which we haven't seen since Tiananmen Square. So I don't think China has the ability to stimulate. So I think they're going to have to go through an extended tough patch. And while that hasn't fully been reflected in iron ore prices yet, we think soon it will be. So again, we like commodities in general, but there's specific areas to play. We like the U.S. steel stocks. We don't like the global iron ore stocks.
How you feel about copper?
That's so funny, Bobby. We think so much alike. That was going to be my question because you mentioned China, you mentioned EVs, you mentioned electricity. Well, how do you feel about copper? Yeah.
We don't. I'll admit we don't have a strong view there. I would say in general, I would expect commodities overall to be strong, but we don't have a strong view on commodity or copper. I'm sorry, either way.
That's fine. Let's go. You had mentioned before, we called the bury the lead or the teaser, that you want to talk about AI stocks. And I assume you want to talk about the Mag 7, the big tech with that. What are your view there?
Yeah, so I believe AI is one of the biggest bubbles we've ever seen. I believe that clearly with DeepSeek, what we saw is you don't need all this investment to achieve a good outcome. The problem is the hyperscalers are still planning to spend massive amounts of CapEx. Now, there's questions around if there's revenue round tripping going. SCMI is something that we need to see their financials. I think at some point this year, and if I knew when that was, I wouldn't be doing this right now. I'd be on a beach because I'd have my investments made and be set to make a killing. I don't know when this is going to happen this year, but I think at some point this year, you're going to get a capitulation from one of the hyperscalers on CapEx spend. And I think that when that happens, I think two of the major black swan events, and not even black swan, but two of the major events that could cause significant sell-off / disruption in the market are either it being clear to the masses that inflation is going back up, which I think is going to happen, or the AI bubble popping, which I think will be set off by a reduction in CapEx from one of the hyperscalers. And I think that is going to be driven by investors saying, you're spending too much money on these data centers that aren't needed and starting to punish these stocks for this aggressive CapEx spend. And I think that happens at some point this year. The question is when, I don't know.
So I've had a thesis, Jim's sick of hearing about it, that in 2025, we're going to get a 15 to 30% drop in stocks. And the second part of that thesis is that's going to be a multi-generational buy. Now, the idea behind the thesis is that President Trump is successful. Now, I don't mean successful I don't use that word as if what he does is a positive or a negative. I don't look at it that way. I look at it like he has said he wants to do X, Y, and Z. And in my view, if he gets X, Y, and Z done, inflation's back near 5.5%. And I don't personally believe this administration, maybe Besson does, but this administration has the tools to understand what to do after that. I was really glad to hear you say that it's essentially a 2-year term. I'm paraphrasing what you said, but if he gets crushed in the midterms, there's not enough time to make that work. So number one, am I nuts? And number two, what has to happen? Let's say Trump in 6 months fires everybody, brings Gordon Johnson in. What's the first thing you tell him to do?
Yeah, so if he brought me in, the thing that I would focus the most on is reducing inflation. And I think the way to do that is, again, to bring down bank reserves, right? Listen, so when we had the COVID crisis, right, what the Fed did initially is they pumped $2 trillion into essentially banks, or you could call it the economy, right? And understandably, nobody knew what COVID was going to be. That was understandable. But after retail sales had gotten back to 15% above trend, after we had vaccine confirmation, they continued to pump money in. In fact, they pumped, I think, another just under $3 trillion in. That was extremely reckless, right? But the problem is, if you look at bank reserves prior to 2009, when Bernanke did he brought QE to the U.S. By the way, any country that's ever done QE has never returned back to the growth that they had before and has seen massive inflation. QE has been a disaster by any study done, right? But my point is, if you look at before 2009, bank reserves were were usually run extremely low. You're talking near zero, right? Bank reserves held at the Fed. And if the banks needed excess liquidity, they would access that via the SFR, right? Now, so they did all this excess liquidity, PAL, during QE infinity. Bank reserves have skyrocketed, and they've done nothing to bring those back down. They need to take that excess liquidity out of the market. They need to let capitalism work, right? Charlie Munger said, capitalism without bankruptcies is like religion without hell, right? And I think we're seeing some of the oligarchs that have emerged and are controlling our government as a result of a lack of, balances and checks, letting companies that said they had funding secured get away with saying that, letting companies sell products that don't exist, not enforcing laws. That is bad. So I would re-implement capitalism, allow the winners to win and the losers to lose, and I would force the Fed to bring down those bank reserves, and I would also force the Fed to sell those mortgage-backed securities and take this fluff out of housing that is basically crippling our young generations and disallowing them to buy houses.
So just to underscore your point, in June of 2021, CPI had already printed over 5%. The housing market was inarguably on fire. And what the Fed did was say something about transitory and hit the gas, to your point. It's just amazing, the recklessness of it in real time, with everybody like us raising our hand saying, guys, what in the hell are you literally doing right now? Like, why are you spurring this inflation on? Bobby, before I disagree with you, I think 5.5% inflation needs to mean some supply chain issues as well. So I'm not 100% with you on that. By the way, one thing before I ask the question, the Elon Musk thing, and I know we probably disagree on Doge. I'm more supportive of it than I'm not. However, the thing with the funding secured, why that man wasn't in jail back then was absurd. Like, that was the most, like, it seemed like a pot fueled, thing to manipulate his stock. You cannot do that. He should have been in jail for that, right?
Well, I can't say whether he should have been in jail or not, but it was the most egregious violation of securities laws. And then keep in mind,
that's what I mean when I say should be in jail.
The head of the SEC at the time said, "Oh, we can't do anything because his company's so big." But it's not just that, right? It's the Paint It Black video. We're talking about Tesla, where in 2016 they released a video that showed a car driving itself around for 3 minutes. It looked amazing. If you look at that video, you're like, my Tesla can drive me around. The video starts out by saying the driver is only in the seat for legal reasons. The car is driving itself. We later found out that video was completely doctored. It was taken over 500 miles, and the car wrecked multiple times. When you let people get away with stuff like this, it's bad for capitalism writ large, because you give other CEOs a blueprint from which they can essentially deceive and sell products that don't exist. And you get, an environment like we have now, where I think
I disagree with nothing of that. I think, again, like I said, there are things we disagree on that we do not disagree on at all. Can we talk about banks real quick? I thought the curve was going to steepen. I still think the curve is going to steepen back towards averages of, call it 100 basis points, 2s versus 10s. Based on that thesis, I did start buying banks a while ago with some success. Where do you stand on banks?
In general, without getting into too much detail, I agree with you. I think the curve is going to steepen.
Okay. And every time the banks came out with their earnings, they said loan growth seems good. Funding, because they fund for the shortest end of the curve, has gone. Funding costs have gone down. So I think that's a pretty good. Bobby, what do you think of that thesis?
Yeah, we talked to Luke Groman yesterday, and he talked about that sort of 5% level in the 10-year. And he said that's really, the more he talks to people and the more he hears people talk, that 5% level is like we sell everything level. And in a weird way, I don't want the market to sell off. I don't. I have a lot of money in the market, but I do agree with that. And I do agree that it's going to get there. And I do think we're going to get to 5.5% inflation if things continue in the direction. I don't think it needs to be supply chain this time. Because
we've disagreed on things before, and I've always been right. No, I'm just kidding.
Well, here's the thing, Gordon, I'm not necessarily convinced that tariffs are going to cause the general level of inflation that a lot of people are saying, because he had the steel tariffs, yet inflation didn't spike as a whole in his last term. Now, you could argue that it spiked in the industries that the tariffs were levied, and he's threatening much more of a broad-based tariff now. So my thesis could be wrong. Number one, we're starting at a lower level of inflation. And number two, tariffs could end up being more broad. But another thing that Luke brought up, and it's part of my thesis for why I think there's going to be this massive sell-off, is the flow of funds could actually switch with tariffs from money coming back into the U.S. in the form of treasury purchases to money coming back into the U.S. in the form of investments to avoid tariffs. But that's longer than a 2-year thesis, ain't it?
Yeah. So I just want to highlight something. If you go back to when Trump implemented the tariffs during Trump 1.0, his first administration, U.S. steel prices, hot rolled coil prices went from 700 to like 1,100. We hadn't seen those prices in decades. So the evidence shows that the tariffs not only push prices of the imports up, but significantly push prices of domestic steel. So if you do broad-based tariffs, I firmly believe you're going to get significant inflation.
This is a legitimate question. The legitimate question: did steel prices stay there, or did they blip and come back off? I don't know the answer to that.
Oh no, they went up and then they came back down. And
when the tariffs were removed,
the tariffs were removed, yes. So he did the tariffs, and then he basically reduced them, and that allowed imports to come back in, more competition, et cetera. So, but the initial tariffs, when he put them in, you had an explosion in prices. And so you have that. Again,
we've got a question.
Yep.
No, go ahead, please. No, please finish.
With respect to your view that the markets are going to slow down and we're going to have a sell-off, I agree 100%. The question is when. And I think that when is predicated on when it becomes consensus that inflation is getting back out of hand. In our view, looking at CPI, PPI, Empire prices paid, reported yesterday, it's already happening, but the market hasn't accepted that. And or when the AI bubble begins to prick. Keep in mind, the AI numbers from Google and Meta, not good. And there were a couple of the parts suppliers that didn't report good numbers either. We got NVIDIA next week. That's key. So I do think that there's going to be a significant sell-off. I think it's going to be driven by those things. I just don't know when it's going to happen.
I think we have a comment from Benny that I think you might have answered already, but in case you didn't, or if you wanted to add on it, do you have any thoughts on the liquidity hole that's been temporarily plugged by reverse repo drainage? Is it set to open up this year?
That's a great question, Benny. So again, if you look at what is being predicted from our Treasury Secretary over the next 4 to 8 weeks, a significant downdrift in the Treasury General Account balance. What that means is you're not going to get a decline in bank reserves. And to get liquidity out of the system, to see liquidity fall in the U.S., that is measured by, effectively, in our view, a decline in bank reserves, right? And if the TGA is falling, that means bank reserves aren't going to fall because that's going to suck up any, buying of debt or decline in bank reserves that the banks have to do. So I think the liquidity near term, next 4 to 8 weeks, is going to be bullish for equities, bullish for risk assets. And then after that time frame, when the debt ceiling gets resolved, add to that what the Fed said today. They said they're going to, they might stop QT until the debt ceiling is resolved. But more importantly, they said they're going to stop reinvesting proceeds into buying long-term debt, which means they're going to stop buying long-term bonds. That's extremely bearish for risk assets. That's another thing that could cause risk assets to sell off later this year. So,
here's my question then, Gordon, because this is fascinating to me. Like every day I keep up a chart of the Fed balance sheet and I keep up a chart of M2 money supply, but I know full well that M2 money supply, we don't even get that information until it's like a month old, whatever, too. So what charts, if we are going to see when the liquidity is beginning to dry up and the crunch could happen, you have the Fed balance sheet, you're saying bank reserves, held Fed, and the Treasury General account. Are those three charts up at your desk all day long, and you monitor those pretty closely?
So here's what we do. What you do is you take the change in the Fed's balance sheet minus the change in the TGA, Treasury General Account balance, minus the change in the overnight RRP. right? The one that's currently sitting at 70 billion. You add those up, and that's U.S. liquidity. And you'll see, right? Remember when the market crashed in 2023? That number imploded, right? But since basically since the beginning of 2023, that number has been flat. There's been no reduction in liquidity. But most importantly, another way to look at that is simply look at bank reserves held at the Fed. If bank reserves held at the Fed start to go up, stocks are going to go higher. If bank reserves held at the Fed fall, stocks are going to go lower because that's less liquidity. And given that you don't have the buffer of the RRP, the overnight RRP, keep in mind, when the debt ceiling was lifted last year, the overnight RRP was sitting at 2.4 trillion roughly, right? Then Janet Yellen shocked everybody, and she significantly reduced the rated average maturity of her debt issuance, right? She issued a bunch of T-bills, right? And what happened was all that issuance was basically sucked up by the RRP. So banks didn't have to buy the bonds. So that RRP was just money created during QE infinity. So what we had last year was de facto massive QE, but it's stealth QE because people look at the Fed's balance sheet and think that's all. No, you got to look at those three items together, but also look at bank reserves. And until bank reserves start to fall, you're not going to get a real sell-off of risk assets, barring AI bubble bursting or inflation surging higher.
So this is my last question because we're running out of time. You talked about the AI bubble. So last year, every year in November, I talk to a former Bloomberg anchor who does this sort of year in preview kind of a thing. I think he does it on TikTok or I don't know what. He's 100 like me, so I don't know what he's doing on TikTok. But he 2 years ago it was gold. Last year it was I don't remember what it was last year, but the year before it was gold. And this year was Palantir for me. Now, if Tim is still watching, he's going to come on here and call me a moron because he hates Palantir. But obviously, I'm doing really well on it. Today, it's getting crushed. When you talk about the AI bubble, what is your favorite and least favorite of those names, if you have any? And how do you feel about my Palantir call?
Yeah. So
I hope you hate it, because that's what makes this interesting.
One second. Let me pull something up here. So I think the best way to play the AI trade is via the energy companies. And specifically, that would be Talon Energy, TLN. We don't have a rating. I don't have a specific view. But I think that in general, I think that what's happening is if the hyperscalers do indeed spend this CapEx and they need thus the energy, I think TLN is a great way to play it. I think the least favorite name, given what we saw with DeepSeek, and thus them showing that you don't necessarily need all these chips, given what all these companies are saying outside of NVIDIA, the Metas, the Googles, that they're going to make their own chips. I think the chip suppliers may be the least favorable way to play it right now. But as we didn't even talk about this,
though, right?
The best short in the market right now, in our view, from a market cap perspective, is Tesla. And we didn't even get a chance to talk about it.
Which, by the way, I want to add something too. You know that people were coming at you from the Tesla thing. We are not people who are coming at you at all too. We love when a guy writes it in ink and doesn't pencil it in. And if you're right, you're wrong, that's fine. You were willing to own it. And that's admirable. By the way, and you were wrong and now you're right. Is that correct? How are we viewing it right now, your results?
Well, looking at the stock, I'm still very wrong.
Okay,
but looking at
still
the
very
fundamentals.
Again, what I'm saying is that I don't give a shit.
If you look at the fact what they just reported, a collapse in operating profit, a massive miss on the EPS line, and keep in mind that miss included what was it, 600 million in revenue associated with an accounting change. So it was much worse than because of this Bitcoin revaluation. It was much worse than even what they reported. Their growth. They went X growth last year. Their growth is negative, right? 5 years ago, everybody was saying Tesla's going to sell 30 million cars. They didn't even get to 2 million, and already they have negative growth. And I think the growth is going to be negative again this year. So I guess the point is, I think very bad things are coming for Tesla this year. And keep in mind, the problem Tesla has is you can no longer say we have regulatory headwinds releasing our FSD. They can release it tomorrow. There's nothing holding Elon back. Here's what's holding him back. It doesn't work. If they release FSD, what I mean by that is unsupervised driverless cars tomorrow, there would be wrecks and deaths all over the United States. It will be shut down within a week.
Right.
And
I want it to come out at some point. There are wrecks and deaths anyway. Someone dies in a car accident every 12 minutes in this country, by the way. So,
right.
I mean,
here's
I'm
a little
hoping.
statistic for you.
Yeah.
Right now, using TeslaFSDtracker.com, which is a third-party source website, these cars are getting into a disengagement every roughly 200 to 300 miles, right?
Okay.
That means they have.
Wow, I was right.
Waymo has a disengagement every 2.4 million miles. The average human gets in an accident every 700,000 miles. These guys are basically having a disengagement every 200 to 300 miles. The point is, this technology is nowhere near ready and won't be ready for over a decade. Yet Elon has told people effectively that he's going to release it in June of this year. The best thing that could happen to a Tesla bear is for him to release FSD immediately, because it will immediately show how far behind he is.
So, and that's the problem you have with Tesla, right? It's not necessarily anything else other than saying that this is ready and it's not, or funding secured and it's not, or all this stuff. That's your big problem with Tesla, other than the books, right? I think you're the first guy I saw on here talking about the accounting sort of, what can I call them to be nice, a fuckery that happened in order for him to show profitability when he did about 2.5, 3 years ago.
Right. The accounting chicanery. I mean, we look at Q3. Q3 was a prime example of creative accounting, the likes of which we've never seen. A lot of that was reversed in Q4. Keep in mind, Q4 is an audited quarter, right? That's when they file their financials. But here's the problem, right? I think there may be some more chicanery in Q1. The problem is what they can't gloss over with accounting is actual car sales, because you get insurance registrations in pretty much every country, including the US, it's delayed. So while the numbers may look better than they should, what they can't fake is the actual sale of their cars. And right now in China, they're trending down 12% through the first 7 weeks. Right now in Europe in January, they're down 50% year over year and quarter over quarter. And the US is an utter disaster. They said they had 1 million Cybertruck reservations. They sold what? Just under 30,000 last year. The problem is Elon Musk has made Tesla a toxic brand, given his political leanings and other, leanings on Tesla. So I think on X, Twitter. So I think that he's really alienated his customer base. So I think there's real problems this year. And the other thing,
still got that camera that follows him around.
Yeah, the other thing is Tesla, they can release FSD right now. There's no regulatory hurdles, so they won't be able to use that excuse this year. So I think this is the year for the bears. The rubber meets the road. I think Tesla has big problems.
We got Tim's question up there, but we also have a question from our studio. So I'm going to ask Tim's real quick. Then I'm going to get to guys in our studio. Then as far as I'm concerned, we can call it. Tim asked,
I'm losing power. You just talk while I figure out how to plug my thing in.
Is there any risk that the private lending markets can cause an issue in the general markets? It's my guess on what he's saying.
Any risk that the private lending markets? I mean, absolutely. If rates continue going higher, that means less lending activity, thus less overall economic activity. And basically, all rates are is a derivative of what bond investors expect inflation to do. And as I explained earlier, I think inflation's headed a lot higher.
So we got a question again from the studio as opposed to the audience, which is kind of cool. I don't think we ever had one of these. That means you're engaging everybody. Max says Waymo cars are on rails. They are on a pre-programmed map. How you compare a vision-based system based on a map system. Tesla cars can drive anywhere. Waymo cars are super locked into an area. Can you ask him? Max, I'm not sure you worded that the way you want to word it.
I think that's a very important point. What was the guy's name? Matt?
Max, yeah.
Max. So Max, here's what you don't realize. Elon Musk is going to do exactly that in June. He is going to have a geo-fenced, mapped, teleoperated car in Austin, Texas, that effectively is a limited fleet. He's doing the exact same thing that you are poo-pooing Waymo for right now, right? That is what he's going to do in June. It is not going to be an unsupervised FSD technology in your car where you can take your hands off and Tesla takes liability if you wreck. That is what he's been promising since 2015. That's absolutely not what he's doing. He's doing what Waymo is doing, yet he's way far behind because Waymos are no longer teleoperated. So what you just put on, Max, is exactly what Tesla's going to do. They're shifting the goalposts, and it's going to be, I think, a big disappointment.
I was going to say, if I could paraphrase your view on Teslas, you don't love it. It's a joke. That's a joke. I liked your passion. No, I love the passion. That was great. I got a smile from you there. Bobby, do we have to do exactly what I'm saying too, Tim? I'm like, yeah. But should we call it, Bobby, or no? This is
we're done. We're through our hour. We can't hold Gordon any
longer. Can't hold you forever, and we can't hold our producer. Thank you so much. Tell them one more time where they can find you, Gordon. Your passion was great. I loved it.
My firm is GLJ Research. We're a sell-side shop, and we try to get the calls right.
Thank you so much for being here. It's been an honor. Thank you guys for watching too. Again, we don't tell you guys enough how humbled we are by the support we get from you, all the DMs, all the retweets. It is fantastic. We didn't know it would explode both of our shows like it has, and it's because of you guys. Thank you. This is the Trader's Edge. Tradier is the Trader's Edge. Please go to the Tradier Hub. Please try Tradier Pro, and thank you guys. I'm Jim Iuorio. That's Bob Iaccino.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.